scared do we really need to be about rising interest rates and the national debt? Let's look at the historical data and some empirical facts. In just the last 6 years, the national debt has exploded from 20 trillion to over 30 trillion. At the same time, the Federal Reserve has been jacking up interest rates to fight inflation. So now people are starting to get concerned about the cost of the interest on the national debt. The basic thinking goes like this. Interest rates have moved from 0 to 5%, and the national debt has gone from 20 trillion to 30 trillion. And that creates the risk of this sort of interest rate spiral where the interest payments are so large that you end up getting a high rate of inflation that ends up destroying the currency in the long run. Let's go back to basics here to get the context of this potential problem accurate. So it's important to understand the gross national debt versus the debt held by the public. The gross national debt is the total of all the debt that's been issued so far, and as of 2023, it totals $31 trillion. The debt that's actually held by the public is just $25 trillion, and that excludes things like the Social Security Trust Fund, which is technically income that it's paying to the federal government itself. The other item that alters the headline figure is the Federal Reserve's huge treasury debt holdings. Since they started implementing quantitative easing, they've accumulated trillions of dollars of U.S. government debt. That's interest that's being paid by the Treasury to the Fed and then remitted back to Treasury at the end of the year. So even when we back out all of the intra-government debt from the Federal Reserve and things like the Social Security Trust Fund, you still arrive at a huge number of $19 trillion. We can then look at the weighted average of outstanding debt. It comes out to about 6 years, 74 months. That's an interest payment of about 3.9%, or roughly $760 billion per year. So now we can start to apply some historical data to this. If we look back at the history of the interest payments as a percentage of GDP, you can see that at present we're at about 2.5%. If we go to 800, even 900 billion, that's going to take us roughly to something like the 3.5% range in terms of as a percentage of GDP, which is roughly in line with where we were for most of the 80s and 90s. There's another huge variable in this equation though. What is the knock-on effect of higher interest rates in other sectors? So while interest payments from the government will force the government's balance sheet to potentially expand more, what will interest rates do to other sectors of the economy? And will they force less borrowing, less interest income to accumulate in other sectors as interest rates cause a slowdown across the rest of the economy? The bottom line is there's 3 big conclusions here that can lead us to be very skeptical of the hyperinflation or debt spiral narrative. And that is, 1, the headline figures are likely to be much smaller than what the media tends to portray. 2, we've been here before. We know that the 80s and 90s interest rate payment levels didn't cause hyperinflation or a debt spiral back then. And number 3, will interest rates of these levels actually cause the risk of deflation rather than high inflation, as other sectors are forced to be suffocated by the high interest rate payments that come to fruition over the coming years? Thanks for watching, everyone. I hope you learned something new. I'll catch you next time.